From the morning reading, the SPX and the NDX pause for the second straight day. Adobe gaps higher on earnings per share. Breadth strengthened compared to the prior session as advancers led 1802 to 1215 on the New York Stock Exchange and led 1673 to 1167 on the NASDAQ. On the S&P 500 snapshot, the down post-Fed hike, but up week over week. Following Wednesday's Fed hike announcement, the S&P shot up over the next few hours until its close. Thursday's index dropped after its open and oscillated within a smaller range. It opened Friday within that same range and closed the week with a 0.24% gain week over week and a 0.13% loss from Thursday. The U.S. Treasury puts the closing yield on the 10-year note at 2.50%, up from the previous close. In other news, the smart money has gone heavily short again. Large commercial hedgers and the equity index futures have established a $62 billion short position, their second largest exposure against the stock market in history. The only time they had a larger bet against stocks, last August, the S&P lost about 5% over the next 2 months. Black swans are on sale again. The skew of options prices is showing that some traders are placing a high premium on protection, which is being masked by the VIX that everyone watches. This indicator has been more extreme only twice before in the past 20 years. As they bet against stocks, hedgers are betting on bonds, shorter-term notes actually. Hedgers have gone net long more than 200,000 contracts on the 2-year treasuries, which have preceded nice rallies in the SHY fund. Other hedger movements, among other contracts, the most notable move was in the British pound, where they've now established an all-time record high net long position. More weird breadth readings. Advancing securities on the New York Stock Exchange accounted for only 43% of all volume, while more than 60% of the issues actually rose. Since 1965, there's only one other day with a divergence like this, July 4th, 2004. With lesser divergences, less than 45% up volume, but more than 55% up issues, stocks struggled over the shorter term, with the S&P rising over the next 7 days, 9 out of 24 times, averaging a negative 0.7%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:28 a.m. Mountain Time, and I'm recording this in preparation for the market day of March the 20th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, just a bit of weakness. The S&P, NASDAQ, and Dow futures were all down just below scratch. Russell futures were down a bit more significantly. They were down about 0.25%. Crude oil, which has rotated to a new contract, is now down 1.30%. Euro is up just above scratch. Long bonds down just below scratch, and gold up just above scratch. In overseas action, it looks like Japan might not be open. China is open, and they're up about 0.4%. Hong Kong's up about 0.8%. Germany down about 0.3%. United Kingdom down about 0.21%. And macroeconomic reports of note for today for the United States. FOMC member Evans is speaking during market hours. And we have President Trump speaking tonight. And then looking forward to tomorrow, FOMC member Dudley is speaking before the market opens. And then we have current account, and that's it for tomorrow. So some activity for the beginning of the week on the macroeconomic reports, but nothing terribly significant. In terms of current volatility conditions, you heard one of the morning authors mention about skew, And look at this, 154.34. I've never seen a skew this high, I don't believe. I believe the morning author mentioned that it had only been this high twice. Let's see if I can find that really quick. Let's see here. Indicator's only been more extreme twice in the past 20 years. So this indicator right here is way out in the warning section. So keep that in mind. Short-term VIX at the same time, though, is only a 9.87, so very low. IV percentiles are also exceptionally low, with 3 of the 4 of them being in single digits. The S&P at a 5, the Russell a 3, the NASDAQ a 5, and the Dow a 17. On the standard deviation size moves, only one index put in such a move on Friday, and that was the S&P was down at 1 standard deviation. In terms of the charts, let's go ahead and bounce over there. S&P, you see basically noise, just small range, chattering inside of recent action. Very much in a bit of a rectangular box, and until we break out of that box, either to the high side or low side, it's really just noise. And frankly, most of these ranges, you take the high side of this, we'll take the 2400 as the high side, and low side, we'll call it 2355, so less than a 50-point range top to bottom within that box. So relatively small consolidation pattern, and would not take a lot to break out of either side. In terms of the Dow, if we mark the top at around 21,160 and the bottom, we'll call it 20,740. Also relatively small range, very tight. The entire pattern last week, very, very tight. Even with the Fed announcement, which gave us a bit of an afternoon kick on that day, the rest of the action of the week was very, very small. NASDAQ also, any other time we'd think of this as a bull flag, and it very much could continue this pattern. And yet at the same time, in the context of everything else, for the most part, this seems to be pretty much a sideways range, though on Wednesday after the Fed announcement, we did push up higher with the NASDAQ. On the Russell, you see this index did make a bit more of a move towards the end of last week after the Fed announcement, and then into the closing of the week was definitely a move up, but it had fallen the most, and it came down to the cloud and then bounced basically off the cloud area and back up. So the Russell in the very, very short term has been the most responsive for the bulls, while at the same time the other indices have been pretty much mired in a sideways small range type of movement. In other markets, we've got crude oil, which is rotated to a new contract. So be aware that if you're a futures trader, volume is all on the new contract now. Also pretty much in a sideways movement after the sharp drop, and then you see the long bottoming tails here and so forth, finding some bottoming support, and at least at this point is consolidating off of that bottom. I would not be surprised to see crude oil break down below this and leg down once again. Gold has been also in a bit of a retracement after having the significant fall, has bounced off of its lows and has moved back up, but is now starting to see smaller range action and starting to consolidate. So the question will be, do we get the next lower low, or do we continue with a higher high from the previous more intermediate term type patterns? In terms of bonds also has been mostly in a sideways pattern, but did break down the last 2 weeks, made a new lower low, and has been in a sideways consolidation pattern the last couple 3 sessions. And expectations here would be for bonds to continue to fall and would take out this 145 handle sometime in the future. Let's see, other markets. DXY. Let's use this one. So you see the dollar. Dollar, of course, is a big part of what's happening with bonds, gold, and crude oil and other markets. And you see the dollar has broken down below the cloud. So while we'd had something of a bounce moving up through the cloud and even breaking out of the cloud, that was short-lived and then fell back, and then with the action in the middle of last week broke down and is now on a breakout below the cloud. So we'll probably be looking to see this take out this low. If that happens, we could have on the intermediate term a set of lower lows and lower highs coming into play on the intermediate term structure for the dollar. So that definitely would have some implications for our other markets. We'll continue to watch the dollar and see how it impacts crude oil, gold, bonds, and then equities by their various correlations. Okay, I think that's probably enough on the charts for today. In terms of the daily report, we still have some kind of choppy mixed signals. Overall, the market trend intermediate term phase opinion still market phase 5, the break of diagonal support. This has been a relatively weak warning thus far. It is possible for us to build on this and have the break of horizontal support and something more significant. But at this point, we've been seeing an oscillation between market phase 5 and market phase 4, which is actually a bullish phase. And we don't want to make either side too valuable until we start to see something more significant develop. So we'll take this as a weak warning at this point. In terms of the three market timing signals, the first one coming from IBD, confirmed uptrend, that's a bullish signal. The second one, the GMI index, is at a 5 out of 6 and a 6 out of 8. That is a buy signal, and that buy signal has been in place since 11:10, so bullish there. Stock charts decision point scoreboard, this is the one that we generally think of as the more sensitive of the three market timing signals because it gives us, multiple indices and multiple time frames. And we see on the short term, we do have mixed signals on all four of the indices, as it were. As such, we're definitely expecting the short term to be not much of a bias to either direction. And until we break these patterns and either establish a clear breakout to the top side or bottom side, it's going to be a bit messy. Now, this is meant to be a market timing signal along with the IBD and the GMI index. Our primary time frame is the intermediate term, and on the intermediate term, we do have all green signals. Also, in the long term, we have all but one as a bullish signal. So overall consensus, and you put all this together, is still to the bullish side, especially for those of you who trade in, the more intermediate to long-term time frames. But that being said, clearly we're experiencing some short-term weakness in the markets, and until that resolves back to the top side, it has to be considered to be something of a bit of a short-term warning. Position sizing opinions are both still at 100%. Intermediate term market posture is back into the exceptionally strong bull for the S&P, the Dow, and the NASDAQ. The Russell's been improving as well as back to weak bull and is closing in on the 50 line. If it goes over 50, it'll go to strong bull. So we've actually seen, with the end of last week, some improvement in the intermediate term market posture. Now, one warning to this is that we've actually had a falling sentiment line. This is a longer term indicator and generally indicates to us that when we have bearish legs, that the bearish leg could be a bit more persistent and longer in duration and strength than the bullish legs. Now, when you put this together, exceptionally strong bull and then a falling sentiment line, generally what we would read from this is that the expectation of not very big moves to the upside or to the downside. If we do have weakness, we probably don't go very far. It could be more of a consolidation by time than by severe price. might be a higher probability expectation. Obviously, we'll continue to watch our indicators and see if something starts to build. Remember, we always talk about change and then rate of change. And if we start to see these warnings start to pop across more and more indicators, we'll start to pay more and more credence to those. Right now, these are just some very, very weak warnings. Gets our attention, and we don't want to make too much of this bit of weakness in the context of a larger bullish market until we've been proven that we should. Hedge warning status, level 0 plus, normal with some elevated conditions. In terms of the three strategy opinions, really no changes here. Still being relatively conservative and covered calls, and this is in alignment with what we just talked about with those market timing signals. Not a lot of expectation of big moves to the up or downside, so having this 1-to-1 ratio of out of the money, in the money strikes, and a 1-to-1 ratio of high beta, low beta positions, makes the most sense with the current market tone. In terms of option income strategies, we've got this really high skew and, some other warnings coming into play. And certainly we want to be aware of that as option income traders, while at the same time, we've got this really low VIX. So we're getting low premiums relative to the amount of risk that we're taking on. And for novice traders, that could be a bit of a problem. For example, right now, if you look at the S&P and you do a traditional 10 delta bull put spread, you'll end up getting very little premium for that. You find yourself often, if you've got a certain premium that you're looking for in order to take a trade, all of a sudden you're looking at a 13 or a 14 or a 15 delta in order to get that premium. And so you're much closer, both by virtue of the low volatility, and you're also closer in terms of being able to get enough premium to justify taking the spread. So for a novice trader, this could heat up really quickly. So you've got to be ready with those adjustments and that capital to make those adjustments if you're going to play an option income strategies in this kind of market environment. In terms of specific areas of warnings to indicators into the volatility based area, we do have this low volatility and we have this really, really high skew. So kind of interesting there. In terms of trend based, we have this weak market phase 5 warning, but then that's then matched up with an exceptionally strong bull and the New York Stock Exchange 1 month indicator actually popping a nice bullish signal with Friday's action. Then on the intermarket risk aversion indicators, we've got, now 4 as risk off against 1 risk on. So that seems to be starting to build a bit more of a warning to the downside of the market. So again, we'll continue to watch and see if this starts to build in terms of angle and separation. These have been flipping back and forth, and where we normally think of the intermarket risk aversion indicators as our more sensitive indicators and the ones that kind of help us understand when there's turning points and things are starting to change. As with the rest of the market, these have been kind of flipping back and forth, oscillating on a kind of largely sideways patterns of late. And that kind of market condition makes many of these indicators that are oscillator in their nature, kind of weak, not their best performance when you're in this kind of sideways overall consolidation type market. In terms of sentiment, we're relatively benign here, and you see the fear and greed index is actually in the neutral at a 45. In terms of sector specific, some of our weaker sectors across the 3 market posture timeframes right now: transportation, telecom, healthcare, energy, financials, and then retail. So kind of an interesting mix there, and a bit different than what we had been seeing earlier, several weeks ago when financials would have been super, super strong all the way across. We'd seen healthcare kind of firming up of recent. Some of those have started to kind of fall off a little bit, and this is somewhat telling. It's very difficult for the broad market to be strongly bullish without the participation of financials. So that is a bit of a concern right there. Retail's been very weak, and for the most part, strongly weak for the most of the part time lately, but Certainly, that's not been an easy sector to be a bull in of late. Other sectors that have been more consistently in the performance category have been the utilities. Probably, in many ways, this has been the best signal of late. Technology also has been generally pretty consistent to the bullish side of late against multiple time frames. So kind of keep that in mind. And indeed, when we look at our 3-month, 1-month, and 5-day performance, look at there. There's utilities. It is about the third best performer on the 3-month. It is the best performer on the 1-month. And it is the second best performer on the week. So just good old utilities, good old dividend-paying utilities, just Mr. Consistent of late, even in the face of interest rate changes and so forth. Something to be said for having a piece of utilities in your portfolio. In terms of other sectors, in terms of recent performance, not terribly exciting in terms of big pluses or big minuses here in this last week. This is mostly a reflection of this kind of sideways action. In terms of relative rotation graphs, a couple industry groups or sectors to pay attention to. Home construction, we've had DHI, and some of the other components of home construction have been doing very well lately. We've had biotech that's also been doing pretty well. Now, healthcare seemed to fall back a bit towards the end of last week, but on a weekly basis, the biotech component has been experiencing some improvement. So be sure to keep an eye on that. And then our old favorite FDN continues to, and now in that upper right-hand quadrant, continue to perform. And you see after having fallen off, FDN had been up here and then tailed way down and now has rotated back all the way up into the upper right-hand quadrant once again. So particularly like this home construction and this internet index fund at this time. Other funds of interest, and these are kind of interest rate sensitive again. Here's your XLU, that's your utilities, and then the IYR, which is your REITs. So a couple interest rate sensitive have been, while tailing a little bit in this upper left quadrant this last week, certainly have been fairly strong performers in most of the recent weeks, the more intermediate term time frame. Okay, that should be enough for today. Let's go ahead and wrap this thing up and get it to production. And I'm going to fly through a couple of these slides. Hit pause button or back up if you need to see something more. I'm going to get to the disclaimers here. And the disclaimers, as always, hit the pause button if you need more time on the disclaimers. Also note the full set of disclosures can be found at the hyperlink down here at the bottom of the slide. Manage that risk profile. Go out there and learn something about your trading each and every trading session. And we should be back here probably Wednesday with our next market preview production, unless something significant happens to the market, in which point we will always come and put out a new market segment. Good trading.